This last point is worth reiterating. Net present value is a very simple decision rule to use when trying to decide whether or not to make an investment. If the net present value, essentially we take all of the future payments, convert them into present value terms, and add them up. If the net present value of a stream of payments, both in and out, is positive, then it's a good investment. If the net present value is negative, then it's a bad investment. So when we want to buy a stock, usually we need to subtract the payment we make right now with no discount period because it happens in the present, and compare that to the present value of all of the future flows from the dividends and the resale of the stock. And if that's positive, then it's a good investment. The same methodology goes for thinking about loans or thinking about trying to decide whether or not to invest in an apartment complex or something like that. If the net present value of an investment opportunity is positive, it's a good one. If it's negative, then it's a bad one. One other point that's important to note is that the risk associated with an investment opportunity is positively correlated with the return you can expect. An investment that is highly risky is going to need to pay a higher expected return or a higher interest rate or a higher dividend or something like that to justify your making the investment. People generally prefer safe options to risky options, and in order to be compensated, in order to take on extra risk, people need to be compensated with higher expected return. If you see an investment that has a higher risk, the way to deal with this is to apply a higher subjective discount rate. So if we see an investment that is very risky, we might apply a 15% discount rate to it. If we see one that's very safe, we might apply a 2% discount rate to it. And we choose investments that have a risk and return that's consistent with our own subjective discount rate. Risk can be reduced in a number of ways. One way to reduce risk is to buy insurance. We reduce the risk of loss on our cars or our homes by buying homeowners insurance or car insurance, or medical insurance works the same way. And we can hedge our stock market bets as well. We can hedge our stock market investments as well by buying assets buying some assets that rise at the same time that other assets fall. And then we can also, of course, choose less risky investments. We can invest in safe bonds rather than risky penny stocks or something like that. And by choosing less risky investments, we can handle things that way. Diversification is an important thing to understand. Investing in stocks, for instance, carries with it risk. Investing in companies comes with risk. And there are two components to this risk. The first component is firm-specific risk, and the second component is market risk. We can diversify against firm-specific risk fairly easily by holding a bundle of stocks and taking advantage of the fact that when some stocks rise, other stocks will fall. A simple but perhaps extreme example is to consider the difference between Coke and Pepsi. Consider owning Coke stock versus owning a bundle of Coke and Pepsi stock. If Coke steals market share from Pepsi, we win if we own Coke stock, lose if we own Pepsi stock, but we essentially break even or diversify our risk if we hold both. That kind of risk is easy to diversify against. What's impossible to diversify against is what happens if the demand for soft drinks rises and falls. If the demand for Coke goes up, or the demand for soft drinks goes up, then this will affect positively both the price of Pepsi stock and the price of Coke stock. If the demand for Coke and Pepsi falls, say due to a recession or something like that, where consumers are consuming less, then the price of both stocks will fall. This is risk that we cannot diversify away from it. So firm-specific risk we can diversify against by holding a bundle of stocks where some rise and others fall. Market-specific risk, where all stocks are going up and down with the state of the economy, is risk that we cannot diversify away from. The efficient markets hypothesis is a hypothesis about the way that the stock market works. And the strong version of the efficient markets hypothesis says that stock prices reflect all available information. That is, if we know something that will be good for a company in the future, say that we expect there to be that we expect that their new invention will come on the market in 6 months and begin to sell like crazy, that the stock price should go up today, not 6 months from now when they first start selling their new invention. If the stock price reflects all current information, then we shouldn't be able to predict what is going to happen to the price of the stock in the future. The efficient markets hypothesis predicts that stocks will follow what's called a random walk. That is, we can't look at where the price has been to predict where the price is going. And it's important to note that this is a very good, but it's not a perfect approximation of the data. People who study stock prices can find some anomalies in the random walk hypothesis, but it's still a very good approximation, and it's very difficult to beat the market. Most financial managers, for instance, these are people who are paid lots of money to try to predict stock prices. Most financial managers who have one good year don't typically have a better than average year in the future. So while some people will do well in a given year, if we expect that it's possible to beat the market by doing serious research and finding anomalies, then we should expect the same people who beat the market in the first year should be able to beat the market in the next year. But we don't find that. There are very few managers who are able to consistently beat the market average return. One thing that's worth noting is that investment bankers and investment brokers and mutual fund companies charge fees for actively managed stock funds. And while those might do a little bit better than the market averages, they usually don't do so much better as to justify their fees. And so if you hold an index fund, which is completely not managed at all, which is just a collection of stocks that are chosen beforehand, then those on average will do slightly better, or at least just as well, as an actively managed fund once you subtract out the fees of the fund manager. So while the efficient markets hypothesis isn't perfect, for the average investor, it's generally a good idea to behave as if it were.